thinking of it from a seller's perspective, if I'm able to offer somebody, let's say, a 4% interest rate by assuming my mortgage, and everybody else on my block is at an 8% interest rate, I should be able to create a premium for the payment I'm giving that buyer.
Absolutely.
For sellers that are in that position, creativity involved with that in terms of like, how do you quantify that? Good morning, Charleston, and welcome to another edition of the Brian Beatty Real Estate Show here on the Big Talker, 1250 WTMA and WTMA.com. I've got a special show today. We're here with David Stein of Crown Home Mortgage, and for those of you that are longtime WTMA listeners, that name should ring a bell. David, you had a show on here for a while.
About 3 years, finished it up about 5 years ago. You followed my show, and it was a pleasure to have you following that and giving great advice out to the Charleston area on mortgage lending.
Fantastic. So we're going to talk about the state of the market today. We're going to talk about some creative solutions that I just don't hear a lot of people focusing on right now with regard to financing a purchase. You know, we all know that rates are high. We all know that the market is about as unaffordable as it gets, right? I mean,
in many years, yes.
It could be worse. Of course, it could always be worse. We're going to kind of paint the picture of where we are right now. And then when you really start working with seasoned, experienced professionals, you get this unique ability, I think, to tap into the creativity that, let's just be kind of brutally honest, some newer agents just don't know about or aren't comfortable with yet because they haven't done them before.
Absolutely.
Not to say they're not available. They just... You know, this takes a little forward thinking. It takes some creativity, and it takes experience. So if at any point in time you guys have some questions, you want to reach out to us, you want a consultation on the purchase or sale or investment of real estate, you're thinking of maybe keeping your home, moving, and then renting your existing home out. We also own a property management company. So we're here to help. We're here to offer advice. We're here to counsel. We're here to earn your business as well. So the number to call, if you have any interest in doing so, or text is 843-800-0065. That's my personal cell, 843-800-0065. Or you can check us out at listingsincharleston.com. That's listingsincharleston.com. And just as a quick caveat, that website's getting a bit of a facelift. You can also go to brianbeattyteam.com. So, David, let's just kind of paint the picture of where we are right now. You know, home affordability is the worst it's been since the early 80s. Rates have risen faster than really at any other time in recent history. Back to the late 80s, it's gone up about 5 percentage points in a little over a year.
Yeah, it's the quickest rise of interest rates we've seen, like you said, since the 80s. And it's been a roller coaster, obviously, with what's going on in the world. It's something we can't control, but we can adapt to it. And
right.
Like you said earlier, we have to be creative and have to come up with some solutions because people still want to buy homes.
Tack on to that the fact that, you know, we now have over $1 trillion in credit card debt. I mean, 2.5 years ago, we were under $750 million. So that has a meteoric rise. We've got total household debt at a little over $17 trillion now, both of which are records, by the way. From a national perspective, you know, you have to earn $115,000 a year to afford the median priced home in America. Now, locally, you know, our home affordability index, which we'll get to a little bit later in the show, because I'm going to read some real live stats for you guys to just show you where we are as a specific market and not focus so much on the national real estate market, if there even is such a thing, because it's so, you know, different from coast to coast and from neighborhood to neighborhood. But we have a home affordability index, at least as of last month, of 65, meaning the household median income is only 65% of what's needed to afford the median priced home in our market. By the way, given prevailing interest rates and a 20% down payment.
Correct.
So for the people that are putting, 3-5% down, it's way worse.
So, we try to come up with ways to combat that affordability because you're talking about payment shock, really. Mm-hmm. People who are, let's say they're currently in a home and they want to move up and they're sitting in a rate under 4%. Rates right now that are more than double that, it's affordability. So how do we combat that payment shock? Well, we have a couple of programs that we offer, 2-1 buy downs, which allow us to start that mortgage payment at 2% below the note rate. So, for example, if we're at 7.5% on a typical 30-year fixed rate right now, you would start at 5.5%. That gives you a little leeway or less payment shock so that you're not, doubling your payment. You can afford it. As time goes on, each year it goes up for the second year, and then it locks in for the third year. But the thinking and what the experts are saying out there is by the end of next year, we should see some relief in rates. They're thinking a range of 5.5% to 6.5%. They thought we'd be there now, but we're not. Things have happened in this world and in our own country that may have changed that trajectory. The rates will come down, and you can always refinance into a lower fixed rate at that time. So it's really about a small period of time that we're trying to keep that affordability, and we're doing it with the 2-1 buy downs. ARM rates are starting to become more attractive, and people are also looking into interest-only loans. You're unfortunately not paying any principal towards your house, but the interest-only payment is a lower payment, and the payment affordability is the big key out there.
I remember, because I got started in 2006. How long have you been
I've been doing this 28 years, since 96.
So you got me by 10 years. I remember, post-2008, a lot of folks got into a lot of trouble because they had adjustable rate mortgages and things just never got better.
Yeah, those adjustable rate mortgages, though, were not because of wanting a lower rate. It was because of the subprime loan crisis that was out there. People were getting these 2-year ARMs, and then after that 2 years, what happened was the rates went up 5%. The caps were very high. And that's when the housing caused the crash. We're not in the same type of market that caused the 2008 crisis.
So I wanted to draw that corollary really quickly because I think there's still maybe a little bit of scar tissue with regard to adjustable rate mortgages for the folks that had it, and then, their 2-3 year ARM came due and the property's worth less, they have less equity or no equity.
They would just walk away.
And they just walk away. And I mean, that's really how my business shot way up. I did a ton of short sales and foreclosures on both sides of it, helping sellers. I did about 100 or so short sales, helping sellers get out of their mortgages that were more than the value of their home, and letting them walk away with very few cuts and bruises. There were only, I can count on one hand the number of times where somebody owed something
at the closing,
like a cash contribution or a promissory note. But so are you an advocate, you'd say, for ARMs at the moment?
Yeah, the ARMs that you're talking about from the 08 period were the option ARMs, where you could choose to pay a below market rate, and that interest spread that you weren't paying. If your note rate was, let's say, 6%, they were allowing you to pay at a 2% rate. And those loans were designed for people who get bonuses at the end of the year, Wall Street type people, someone who needs lower cash flow on a month-to-month basis. But at the end of the year, they get a large bonus and they catch up, pay all the interest off, and pay some principal as well. What was happening is people were selling those products to the wrong people, and people who were W-2 wage earners didn't have that bump at the end of the year of a bonus or something. So they always were playing catch up on that interest. The ARMs today are fixed for 3 years, 5 years, or 7 years at a lower interest rate. And after that initial period, the rate can go up depending on where the market is. So it gives you some relief on that affordability in the beginning, locks you in for 3. The average we're seeing out there is the 5-year ARMs. So you have 5 years of a lower payment. And then within that 5 years, we think rates are going to come down. You can refinance out of that ARM into a fixed payment so that you lock in a lower interest rate down the road.
And you don't have to wait.
You do not have to wait. Owner-occupied properties do not have prepayment penalties. Investment properties can. It doesn't mean it's mandatory, but they can. But owner-occupied primary residences, you can refinance at any time. Obviously, there's some fees. However, at Crown Home Mortgage, on anyone we do a purchase for, we do a free refinance down the road because we know that the rates are going to come down. We want you to come back and work with us, and we're going to waive all of our fees on that second transaction.
Awesome. All right, so here's another stat. 1 in 4 people in America have an interest rate below 3%. 62% are below 4%. 83% are below 5%, and 92% of people are below 6%.
And that's why your world has no inventory.
Exactly. I mean, I would say that the Fed is accomplishing their goal,
yes.
Right? They're destroying demand.
Absolutely.
And I've said that
They're trying to.
And I've said that for months and months and months on this show. I would like to think that for the folks that listen, they would agree that we're kind of ahead of the curve with regard to what's going to happen and then what happens in the market versus just reporting on real time.
Yes.
That's the whole point, is to try and give you guys a leg up on what's happening in this market locally, regionally, nationally, so that you can prepare. But given the fact that we have such a large percentage of people with very attractive interest rates, it presents an interesting opportunity that I think a lot of people aren't focusing on either, and that's assumable mortgages.
Yes. It's a little known fact out there, but government loans, FHA and VA loans, are assumable. What that means is a seller can sell their home with the existing mortgage to a qualified buyer. It's not like, hey, here's my mortgage. The buyer still has to qualify with the current servicer or the original mortgage holder with debt to income ratios, down payment, credit, obviously, to qualify for that loan. But they can go in, assume that loan at the existing rate, and take over the payments for the remaining term, too. So if you're 3 years into a 30-year mortgage, whoever assumes that loan has 27 years left on that loan. The difficult part of that is finding those homes that are assumable, and then also coming up with the down payment, possibly that could be larger than if you did a traditional loan with a low down payment, because that seller is going to want to sell the house at the market value, and you have to make up the difference between his mortgage principal balance and that sales price as your down payment.
Right. So let's think about this from two perspectives: the buyer perspective, seller perspective. Let's say that a home was bought 3 years ago for $400,000. Now it's being sold for $600,000, which is probably pretty accurate in terms of how much homes have appreciated. And let's say at the time that somebody purchased that $400,000 house, they put 20% down, which is what, $80,000. So they had a $320,000 mortgage. Well, the property is being sold for $600,000, which means that buyer has to come up with $280,000 in cash. Or can they not borrow a significant portion of the remaining balance?
You can.
To fund that purchase, obviously, so long as they can afford to do that through the eyes of a lender.
Yes, you can definitely. FHA allows, and VA allows secondary financing. FHA caps you at 105% of the total transaction, where VA, there's no limit. Mm-hmm. So as long as you can afford a second mortgage or to fund that down payment, yes, as long as it counts in your debt to income ratios, that could be a bridge to get into these homes with those low interest rate payments. It gives an advantage to a seller on the market.
Yeah, so that's thinking of it from a seller's perspective. If I'm able to offer somebody, let's say, a 4% interest rate by assuming my mortgage, and everybody else on my block is at an 8% interest rate, I should be able to create a premium for the payment I'm giving that buyer.
Absolutely.
So for sellers that are in that position, creativity involved with that in terms of, like, how do you quantify that?
It's hard, because how much are you outlaying to get that payment, that lower payment? So basically you can look at, two side-by-side comparisons, coming up with a lower down payment but paying that higher rate. How much is that going to cost me? Or do I have access to those funds, whether it's through financing or my own funds, or gift money is allowed, versus the higher payment to the lower payment? So it's really just a choice once you lay out the two options side by side.
Awesome. So we're talking with David Stein of Crown Home Mortgage. David, what's a good way for folks to get in touch with you?
The best way is they can call us, 855-843-5626, or you can find us on the web at crownhm.com. It goes right to our website, and we'd be happy to do free consultations. We offer free advice for anyone that's interested in learning about the products we have, or finding out the options that they have at this time.
Gotcha. We're going to continue the conversation because I actually have a few more questions.
Great.
I know we only had you here for 15 minutes or so, but are you cool with staying for a little longer?
I got as much time as you need, Brian.
Fantastic. All right. So, guys, we're going to take a quick break. We're going to come back, and we're going to continue our conversation with David Stein of Crown Home Mortgage. Remember, if you guys want to reach out to me, any of this is of any interest to you, we're going to talk about things in a few other lights with regard to buying and selling in this environment, some options that you may or may not know about. This particular episode is really all about just creativity.
Yes.
So if you'd like to reach out to me, you've got some questions, you want to get in touch with David, you can jot that number down in time. My number is 843-800-0065, 0065 or listingsincharleston.com. Stick around, folks. We'll be right back.
Visit Brian Beatty's website at listingsincharleston.com.